Okay, so on Monday, I introduced to you or reintroduced to you the statement of cash flows, which tells us how the cash flows, right? Really, it shows us where cash flows into the business and where cash flows out of the business. And we focused all day Monday. It may not have been obvious. It's how things are for me when I'm learning. Like someone will tell me stuff, but it won't be obvious what it actually means until I've like looked at it more. But we really focused on just the operating section of the statement of cash flows, which is cash that flows into the business through our regular doing of business, which is buying stuff from suppliers, buying, spending money on employees, those sorts of things, and then selling stuff to people. Those are the operating cash flows of a business. But I mentioned that the statement of cash flows is broken into three sections. Um, the first was the operating activities, and we learned that there was two ways you could approach doing it: the direct method and the indirect method. The direct method, which just tries to say, here's all the money that came in and here's all the money that went out. But the problem with that is we often don't have good records of that. And so most people use the indirect method, where you can start with the net income, add the depreciation back in, make any adjustments for gains or losses from non-operating activities like the sale of land or equipment or those sorts of things. And then finally do those adjustments for the changes in the current assets and the current liabilities, right? That's kind of what we walked through on Monday. So the other two sections of a statement of cash flow are investing activities and financing activities. These are other ways the business either brings in money or pays out money that aren't part of their normal operating. So investing activities is really just those activities where we are buying long-term assets or selling off long-term assets. Okay. So these are things like equipment, land, vehicles. Those are all considered investments by the business. So the purchase of long-term investments is a negative cash flow, and the sale of long-term investments or long-term assets is a cash inflow to the business, right? So let's see. So here's an example. If we were looking at the balance sheet, we can see, especially if we look at a comparative balance sheet that shows, like, say, what the value of all the assets were at the beginning of the year or the end of the previous year, which is the same as the beginning of this year, right? And then we look at the balances of the assets on this year's balance sheet, we can see the change. We could see, oh, in this case, and this isn't a balance sheet, this is just the account. We can see on January 1st, there was $125,000 in land. And as of October 12th, there was $80,000 in land. So the value of our land, value is not the right word, the cost of our land asset went down by $45,000. We can look at the transactions and see that we sold land for $72,000 in cash. But this is interesting, right? Because you can see that we only credited it 60,000. Can anybody tell me, make an educated guess, how we would sell land for $72,000 in cash, but only credit the land account, which is decrease the land account by $60,000? No, but that's a good guess. It's a reasonable guess. Also a good guess. But no, that's why it's a hard one. I was throwing out there. Don't feel ashamed if you didn't get it. At least you were bold enough to take a stab at it, right? It's confusing, but what happens, if you'll remember, like when we would do a sale of land journal entry, is we'll credit the asset account, so in this case, land, by the cost of the land. So what this is saying is this was a piece of land that cost us $60,000. So we're taking that $60,000 off of the land account. But we got cash of 72,000. So what would the difference be? I actually need another line, right? Because I would have another debit entry called gain on sale of land. Oh, no, that's not true. I could put it here. Gain on sale of land of 12,000. That's what the journal entry would look like, right? We've done those before. So we'd show our cash going up by 72,000, our land going down by 60,000, and the difference between the two would be a gain. We sold it for more than its book value. So you're right in the sense that if there was accumulated depreciation, that would have also factored in. But in this case, looks like we didn't have any. All right. So mhm, yep, yep. We would reduce the asset by 5,000 because that's all it is on our books. It's cost. Right. Okay. So, and I just occurred to me, I said if it had depreciation, land doesn't depreciate, right? We've seen that equipment depreciates and buildings depreciate and vehicles depreciate, but land we don't do that with. It's an IRS rule. Can't depreciate land. All right. So so even though the balance of our account changed by $45,000, what really matters here is that we got $72,000 in cash and then we paid $15,000 in cash. That's going to be our actual change in cash. Okay. So what's 72,000 minus 15,000? 48,000. Okay. Or 47, something like that. 48,000. We are focused on, when we're working on the statement of cash flows, how much cash changes, not always how much the asset changes. Okay, that's important. So if we were just tracking the cash, we would break it down to this. Cash received from the sale of land was 72,000. And then cash used on the sale of land, it says cash received and then shows it as a negative, which I guess a negative receipt is a payment, but it's the cash paid for the purchase of that land. Same thing with their building. We can see on January 1st, the building was 200,000, the building account. Then they purchased $60,000 worth of building for cash. So our cash if we purchased it for cash, our cash went down by 60,000. Does that make sense? The asset building went up by 60,000, but what matters is how much our cash changed. And then depreciation, as we know, is non-cash. So that's why the first step when we're doing this indirect statement of cash flows in the operating section is just to add that depreciation back in, because it was an expense that decreased our net income, but didn't decrease our cash. All right. So the purchase of the building for cash would simply be a cash paid for purchase of a building, $60,000. All right. And then the final section is the financing activities section. So investing is the purchase of fixed or long-term assets or the sale of them. And then the financing section is either borrowing money or paying off debt or selling stock or buying back stock or paying dividends to our shareholders. Those are all the cash flows from financing activities. So financing just means getting the money you need to run the business. Typically in early stage, we borrow or we issue stock. And in later stages, we often pay off debt or buy back our stock, right? If you sold a portion of your company because you needed the money and then the company started doing really well, you might try to buy that back so you're not sharing ownership with anybody. That's pretty normal. Not always. Sometimes in later stage, you need to expand or something. So sometimes people still borrow in later stage too. All right. So the same principle applies. We're focusing on cash. Okay. So if we issue bonds, that means we're borrowing money. That means our cash is going up. If we pay off bonds, that means we're paying out money and our cash is going down. With stock, when we issue stock, means we're selling off a share of ownership in the company for cash typically. So our cash is going up. And if we buy back stock into treasury stock, cash is going down. All right, so let's actually see a little bit of this in action and see if that'll help us um, understand it better. All right. So we have reporting changes in equipment on the statement of cash flows. So an analysis of our general ledger accounts indicates that delivery equipment, which cost $75,000 and on which accumulated depreciation totaled $58,000 on the date of sale, was sold for $20,200. All right. So using this information, indicate the items to be reported on the statement of cash flows. So you're like, oh yeah, okay, I got this. Why? Because I'm smart AF. That means as flip. Yeah. Because this is a PG rated college. All right. Maybe PG 13 on occasion. There's probably some R's out there, but you know, all right. There's probably a few X's. I mean, people are people. Probably some of those too. All right. Anyway, so let's take a look at it. So does the $75,000 that we paid for this show up on our statement of cash flows? And this is a little confusing because it would have showed up back when we paid it, but we're talking now about reporting the sale of the equipment. Okay. So what we paid for it is not going to get reported now. Okay. Doesn't matter what we paid. It will get reported in our books because we will, we'll credit the amount of that account for the amount we paid for it. But this is saying how much cash changed, what's being reported on the statement of cash flows. So what we paid for an asset is not showing up on the statement. And since it's not showing up, then added or deducted is not applicable. Accumulated depreciation does not show up on the statement of cash flows. How about the $20,200 sales price? Yes, right? We're getting that cash. So this is going to be in the cash flows from investing activities section. Because the purchase of equipment, long-term assets, we do it under investing because it's not part. What's the best way to say it? We know that we use equipment in the day-to-day operating of the business. That's why it's confusing, right? But anything that's going to impact a long period of that, we consider that an investment as opposed to, so operating would include things like just the weekly and monthly operating expenses, like our salaries expense, and so the money we pay out to our employees, the money we pay to our suppliers, the money we bring in from customers. That's what we're doing in operating. And so any money made with assets that will span across multiple time periods, we consider that an investment. That's probably using their terminology. All right. And so money from the sales price, is that being added to our cash or deducted from our cash if we're selling it? Added, right? So we're selling it, so we're getting cash. And then this last one, we're using the indirect method. If you remember, I said the steps of doing the operating section are like number one, start with net income. Number two, add in depreciation expense because it's a non-cash expense. Number three, deduct gains or add losses. And so that's a little weird, but what's happening here is we're showing the total amount of cash that we got for the asset, $20,200. So what we have to do then is put any gain or loss in the operating activities section, and we're going to deduct it. Okay, so we deduct gains and add losses. And the reason is because we're showing the full $20,200 we received for the asset. If we also put the gain, which is the difference between what we received and the book value of the asset, we'd be double counting that gain. We'd be showing that gain in the operating income section because we start with net income, and that gain would be part of our net income. So instead, we have to take it off of the operating section because we're going to put the full cash sales price down in the investing activities section. All right, so this is one of those areas that the more I talk about it, the more it starts to feel like we're talking in a circle. There's like all of these things happening. So just remember the rules. Remember I said start with the what do I have to do, and then the why becomes more apparent as you work with it more. So the rule is in the operating section, start with net income, subtract depreciation, deduct or subtract gains from the sale of long-term assets, or add losses from the sale of long-term assets, and then finally make the adjustments based on the changes in the current assets and current liabilities. And then down in the statement, the investing and financing sections, we just focus on actual changes in cash. Okay. All right, let's take a look and make sure I got this right. All right. Okay, so same thing here. Common stock, we issue 4,000 shares of common stock at $12 per share. So 4,000 shares times $12 a share is $48,000. So we'll have an increase to cash of $48,000, and that will go in the financing section. And then dividends. So we can see by looking at our dividends payable account that January 1st, we ended up with a dividend payable, and then we actually paid cash on the 10th. On the 30th, they declared dividends of 14,000 and then actually paid cash of, 14,000 on July 10th. So we know the actual amount of cash that we paid out for dividends this year was 10,000 and 14,000 or $24,000. So if there's an overarching theme to the investing and financing sections, it's that we're just recording actual changes to cash. And so we have to be careful about thinking about it in those terms when we look at these problems, okay? All right, so let's look at another example. Where'd it go? There it is. All right, so here we have the board of directors declares cash dividends totaling 1,000,000. You got to do the Dr. Evil thing. $1,200,000 during the current year. You guys are like, who's Dr. Evil? You guys are too young for the Austin Powers movies, which is good because they're not nice. All right. They are awesome, but they're not nice. All right. Well, there you go. If Beyonce's in something, it's automatically awesome. That's right. That makes the single ladies video awesome, even though it was mid at best. All right. So They declare dividends of $1.2 million. The comparative balance sheet indicates dividends payable of $250,000 at the beginning of the year and $100,000 at the end of the year. What was the amount of the cash payment? So you're like, okay, smarty guys, this feels like you're making me go roundabout to do this. But here's how I would approach it. I would just like make a T account for dividends payable. And be like, okay, so you told me that it had dividends payable of $250,000 at the beginning of the year. Dividends payable is a liability. So its balance would be on the credit side, $250,000. There's the balance at the beginning of the year. Then you also told me that the board of directors declared cash dividends of $1,200,000 during the year. And at the end of the year, there was a balance of $100,000 on the account. So how much did they pay out actually in cash? Because when they go to pay it out, right, they're going to debit dividends payable and credit cash. That's what it's going to look like when they actually pay the dividends. So all I got to know is like, what's the amount of the debit here? That'll tell me how much was actually paid out in cash. Yeah. Yeah. Right. Because this adds up to 1,450,000. So we must have debited 1,350,000 to have 100,000 left. So that's how much cash was actually paid out. That's how I would approach this. The textbook authors, they I'm looking at it on my screen over here, and they just do dividends declared plus the decrease in dividends payable tells them how much dividends are paid. To me, that's more confusing. To me, to see how it all balances works for me. So whatever works for you, you can use that approach, which means but it does mean you have to know that when dividends are paid, that reduces cash, right? You've got to make that intuitive leap so that you could say, well, what's that journal entry look like? And we've done dividends before. We just have to make the leap or the connection to it. So the amount of cash payment for the dividends, 1,350,000. Hooray. All right. And there was much rejoicing. All right. So this is what a statement of cash flows. It's kind of tiny because there's a lot on there. Looks like after we've done all of this work. Okay. So the first section right here is our cash flows from operating activities. And so kind of as a review again, they started with net income, added depreciation, subtracted the gain on the sale of land, and then they made these adjustments for the changes to the current assets and current liabilities. So there was an increase in accounts receivable. Since accounts receivable is an asset, they did it an opposite adjustment. So since accounts receivable went up, they did a decrease or a negative adjustment to cash. There was a decrease in inventories, so they did a positive adjustment to cash. Then there's a decrease in accounts payable, and since accounts payable is a liability, they adjusted in the same direction. So accounts payable went down, so they did a negative adjustment to cash. Accrued expenses payable went up, so they did a positive adjustment to cash. And the income taxes payable went down, so they did a negative adjustment to cash. And at the end of all that, they figured out that they had a $100,500 in net cash flow from operating activities. So all we're doing in this operating activity section is we're starting with net income. Again, the assumption would be in an all cash business, net income would equal cash inflow or outflow if we had a net loss. In other words, we would receive money from customers, we'd pay our expenses all in cash, and then it'd be the same, right? But we know that most businesses don't run all in cash. And so there was some slight adjustments because they had depreciation, which was a non-cash expense, meaning we claim it as an expense on our income statement, but we're not paying anybody for depreciation. We paid for that building a long time ago or whatever it is that we're depreciating. And then all of these adjustments, like our increase in accounts receivable, means the amount people owed to us went up by $9,000. So that money we recorded as revenue, we didn't collect all of it. How much didn't we collect? 9,000 of it. That's what made our accounts receivable go up by 9,000. So that's what all those adjustments are for, to sort of reconcile the difference between our net income and the actual amount of cash we got. Okay. So they had net income of 108,000, which led to them collecting cash of 100,500 during the period. Then the cash flows for investing activities. They got cash from selling the land. They paid cash for the purchase of land, and they paid cash for the purchase of a building. Their net cash flow used from investing activities was 3,000, negative 3,000. So between the cash they received and the cash they paid out for the purchase of land and buildings, they ended up $3,000 in the hole. They paid out 3,000 more than they brought in. That's what net cash flow means. And then their cash flow from financing, they received cash from the sale of common stock. They paid cash to retire bonds, meaning they paid off some of that bond debt, and they paid cash for dividends. So they ended up minus 26,000 in cash from these financing activities. And so then once we add up the cash flow from operating, subtract the cash payout for investing, and subtract the cash payout for financing, during this period, they ended up with $71,500 more cash than they had at the beginning of the period. So if they take this net increase to cash, they add the cash balance from the beginning of the year, it should add up to the cash balance at the end of the year. So you can look at your balance sheets and you can see what that change is, right? If I look at last year's balance sheet, the cash would be 26,000, and this year's balance sheet, the cash would be 97.5. All of this explains where that cash came from and went to. And that's why it becomes so important. Again, your mind would be boggled the number of times I've sat down with business owners who are profitable but running out of money and don't have money to pay their employees and don't have money to pay their electric bill, right? And they're like, I don't understand. My revenue's higher than my expenses. What would you guess are some of the things that would lead to them having a profitable business that's running out of cash? That's the biggie. So failure to collect accounts receivable, right? You're selling stuff to people, you're recording it as revenue, but you haven't collected it. You know why we don't collect? Because it sucks to call people and be like, dude, I need you to pay me. No, really, I need, like, it creates tension to have to force somebody to pay you, right? So that's a big one. Um, it's the biggest one. It's one of the top 8 reasons small businesses die, is failure to collect on the debts that are owed to them. Okay. All right. So that's what a statement of cash flows ends up looking like. Let's create one here. All right. So we have a comparative balance sheet for Olson Jones Industries. It looks like it's just doing everything in dollars. I'm guessing this is like thousands or something, but it doesn't matter. We have dollars here. It also gives us some additional information, like that they sold land, that they acquired equipment, all of those things. So we have to go through this process of creating the statement of cash flows. So remember, step 1 for the operating, so we'll start with the operating activity section, It's very important when you do this to sort of break it down to like, I'm just working on this portion right now. You know how they're always like, be a global thinker, think broad and think about the big picture. In accounting, no. Be a narrow thinker. Think about what you're working on right now, step by step. Okay. Then you can step back from it at the end and be a broader thinker. But this is why accounting's so hard for my wife. She's an artist. She always sees this big vision in her mind and then she starts to create it. But like also with accounting, I'm trying to be like, no, back off. Just focus on this thing. Whereas for me to try to do the thing she does, she'll be like painting something and I'll be like, that's not going to turn into, but I trust her now after 30 years of watching her do it. All right. She does murals. So she paints huge walls and buildings and stuff. And I'm like, all right, I just have to trust you. You've been doing it over and over for 30 years and people keep paying us money. So apparently it's good. All right. All right. So step one, let's start with our net income. So does it tell us anywhere what the net income was? That would be helpful. Equipment, common stock, retained earnings. Okay, so it tells us that's a little bit of a dumb way to do it. So E here says there was a $62 credit to retained earnings for net income. Why not just say they had net income of 62? Okay, so because that's the same thing. They're being Sengagey. You start telling your friends that, like whenever they're being nitpicky about something that doesn't matter, but being so Sengagey. All right, so we're going to start with our net income, 62. And then the next step is we are going to add depreciation back in. So we're going to look up here and tell us in earnings. I bet you somewhere in here. Where? Okay, yeah, so we can see that at the beginning of the year, accumulated depreciation was 42, and at the end of the year, it was 68. So that's a change of 26. Does that make sense? So that's the amount of depreciation that was done this year. So we're adding depreciation back in, or we're doing this as a positive 26. Again, the reason why is depreciation expense reduces our net income, which is what we started with, but it doesn't reduce our cash during the period. Okay. That's why we add depreciation back in. If you're like, that doesn't make sense to me right now, just remember add depreciation back in. Next, we'll see if there was a gain or loss on the sale of land. So we have land sold for 120. So here's our land. We can see land went from 330 to 250. So if I had land at 330 and now it's at 250, that means the cost of the land I sold was what, 80? And it tells me that I sold it for 120. So the gain on the sale of that land is going to be 40, right? It was land that had a book value of 80 and I sold it for 120. So we are going to subtract that gain up here in the operating section. Why? Because the whole 120 that we get is going to show up down below in the investing section. And if we count them both, we'll be double counting it. That's a little confusing. Just remember that we subtract gains and add losses on the sale of long-term assets. Now you know why I saved this toward the end of the class, because I think it would have been too confusing at the beginning. It's too confusing now. So now we're going to look at changes in current operating assets and liabilities. So accounts receivable was 49. Now it's 55. So that means it went up by 6. right? So when we do these adjustments, changes to assets, we adjust in the opposite direction. So if accounts receivable went up by 6, then we're going to come down here and say there was an increase in accounts receivable, and we're going to deduct it. The reason why is because this is money owed to us. And if the money owed to us went up, it means we did not collect all of our sales in cash. How do we know that? Because we're owed more than we were at the beginning of the year. So that's, again, we start with net income, which assumes all the revenue is cash. And then we realize here, oh, there was 6 in this case of cash that we didn't collect. So we're adjusting it down. If that gets confusing, just remember, adjust changes to assets in the opposite direction, changes to liabilities in the same direction, and that will get you through it. All right. So accounts receivable, and then we have inventories. They went from 99 to 117. So inventories increased by 18. So we'll say increase in inventories, and we'll subtract it, minus 18. So that's the end of our current assets. Then we'll look down here. There's only one current liability, accounts payable. We'll see that that also went up from 37 to 51, which is an increase of 14. And with liabilities, we adjust in the same direction. So an increase to accounts payable is going to lead to of 14 is going to lead to us adjusting that up by 14. All right, there's all our cash flows. So now we'll add them up. 62 plus 26 minus 40 minus 6 minus 18 plus 14. That comes out to 38. So our net cash flow from operating activities is a positive 38. We have, if this is in pure dollars, then we got $38 more in cash from our operating activities. Again, I'm guessing it's thousands or something, but all right. Everybody follow to that point? I'm not asking do you fully understand 100%, but did you follow enough that you're there on the problem and you kind of are starting to, okay. That's probably where most of us are. All right, so now we're going to move to the investing activities section. So here we're going to look for, let's see, it tells us equipment was acquired for cash, land was sold for 120. So we're going to say, all right, we received cash from the sale of land of 120. And we purchased equipment. How much equipment did we get? Well, if equipment was 175, remember we record these things at their cost, and now it's 205. Equipment went up by 30. So we purchased equipment for cash. That's going to be a negative cash, right? We're paying out cash to get that equipment. So it looks like we sold land and got $120,000 in cash, and then bought equipment and paid out $30,000 for equipment. So the net cash flow in this year for investing activities is actually positive. We got $90,000 more cash because of our investing activities. That's rare, by the way. Most of the time, investing activities are negative. Like usually we're purchasing assets, but every once in a while. All right. Finally, we're going to come down to the financing activities. So again, we'll look up here and see that there was common stock issued for cash. Oh, this was important too. This says there were no disposals of equipment for the year. So we could know then that that whole change in equipment was just from that purchase, is why they're telling us that. Common stock issued for cash. So we'll come up here. We'll look, common stock was 80 at the beginning of the year, went up to 125 at the end of the year. So that's an increase of 45. So when we issue stock, that's an increase to cash. We're selling it. 45,000. No, 45. Is that right? Let me look at this. Did I do the math wrong? 80 to 125. Oh, there was also paid in capital in excess of par. I didn't see that. So this went up by 45. And then the paid in capital in excess of par went up by 15. So 45 plus 15 is 60. So we got 60, whatever that is, 60,000 or $60 from issuing common stock. And then we paid dividends. Let's see. How much dividends did we pay? We see there's a change in our dividends payable. I feel like I need more information on that one to understand how much dividends I paid. Land was sold, equipment was acquired, no disposals, common stock issued for cash. Here we go. There was a $24 debit to retained earnings for cash dividends declared. So if we declared 24 and the balance is now 5, then we must have paid out 19. Does that make sense? Yes. It's a little confusing. And since it's a payout, we're going to do cash paid for dividends. So 60 minus 19 gives us 41. That was our cash flow from financing activities. So our net cash flow, or our net increase in cash then, is the subtotals of each of these three areas added up. So 38 plus 90, which is 128, plus 41 gives us 169. So this business has 169,000 or whatever it is dollars more cash this year or anyway. So that's what we're doing. So then we can come up here and we can look and say, like, what was our cash at the beginning of the year? 14. And then we add the increase of the cash. So 169 plus 14 is 183. Then we can scroll up and double check. And in fact, their balance sheet does show 183 in cash at the beginning of the year. So, or the end of this year. So that's good. So our net cash flow from operations, in this case, remember our net income was 62 and our net cash flow from operations was 38. So the question is, was our net cash flow from operations more or less than net income? And the answer is it's less. And the sources for the differences are, well, the gain on the sale of the land, the accounts receivable, the increase in inventory. So I'm not sure what it wants us to put here. It wants us to put all those three things I just said, A, D, and E. All right, one last thing in the final couple minutes. We have one new financial ratio, which is called free cash flow. Free cash flow is just our net cash from operating activities minus our cash used to purchase property, plant, and equipment gives us what's called free cash flow. And then we can also use that to create what's called the ratio of free cash flow to sales, which is just our free cash flow divided by sales. And that'll lead us to our last question. Did you guys get those? I went fast, sorry. So net cash flow from operating activities minus cash used for to purchase property, plant, and equipment gives us free cash flow. That's one formula. And then free cash flow divided by sales gives us the ratio of free cash flow to sales. All right. So our net cash flow from operating activities. And then we have our net cash flow used for investing activities. And so all we're going to do here is we're going to say the net cash flow, come here, calculator, 476,000 minus 427,000 gives me 49,000. Oh, wait, sorry. And that tells me 80% of the net cash flow used for investing activities was used to purchase property, plant, and equipment. So I have to take 427,000. That's the amount used for investing activities, and multiply that times 0.8. And that's because it tells me right here. So that gives me the amount of cash that was used to purchase property, plant, and equipment. And then that we subtract from the net cash flow from operating activities, and that gives me the free cash flow. So there are no records which are going to show us this is exactly how much cash you use for property or to buy property, plant, and equipment. So it has to tell us 80% of your net cash from investing activities was used for property, plant, and equipment. So we take that amount times 80%, and then we subtract that amount from the net cash flow to get. So for the 2001 year, we'll do the same thing, 378,000 times 80%. That gives us the cash used to buy property, plant, and equipment. And then we'll subtract that from the net cash flow from operating activities. Typically, we consider free cash flow, the higher the better. That's more cash you have available to use for things other than property, plant, and equipment. So a decline would be, or it going down would be not an improvement, but a declination, or it's declining. All right, there we go. Sorry, went over by a minute. So if you were on time, I stole a minute of your life. If you were late, it's just recompense, right? Anyway, I hope you enjoy the rest of your day, and I hope you remember that you matter, because you really do. No, I'm not joking. He smiled like, nah, no, no. You do. Remember who you are.